Welcome back, Alpha Hunters. Okay, so now we are going to go into a series and cover the different types of option strategies that we have at our disposal to manage risk, maximize profitability, and try to make sure that we can get the most return out of what we are expecting from the stock. Okay. So we'll start that today by looking at the single order, and this is going to line up with a lot of what you just know about calls and puts and their relationship, but we're just going to look at the single order, and then I'm going to share some of my thoughts on the single order, and then why, kind of contrary to popular belief, this order is actually kind of risky and is probably more suited for advanced traders that know how to utilize this strategy. Okay, and then later on, I'll switch over to the broker and we can look at some risk profile charts. That way you can get a kind of a more visual representation for how your P&L will move as the stock goes to different price levels. Okay, so this is called the option strategy template. This is something that I produced to help new people better understand the many different option strategies. Obviously, right now you see a lot of question marks, and over the next few videos, we are going to fill in these top three rows, and then the fourth row down below will be future strategies that can use combinations of different things, and we'll get into more of that on future videos. But let's get into it and start with the single order. So it's simple, right? You can buy a call. You can sell a call, you can buy a put, you can sell a put. So this is how the breakdown of each one of those different order types kind of works, and what you are expecting or what you can expect from the performance of the option with where the stock is relative. Okay, now let's just walk through this and get a quick understanding of what we're looking at here. Okay, so we can buy a call, right? And the cash flow impact of that is going to be a debit or outgoing cash flow. Okay, so we're going to pay for this position. So if the position costs $50, you're going to pay $50. So that's cash going out. Now, what you are typically wanting when you buy a call, not typically wanting, what you are wanting when you buy a call is you want the stock to go up. And you want it to go up at a rapid pace. Where you can expect losses, basically you're going to take a loss anything under the break even, right? So whatever you pay for this option is your maximum loss, okay? Now, anything between the purchased strike, the strike that you purchased, to the break even point, it'll incrementally be smaller all the way until you get to your break even spot. And your break even spot for this strategy is going to be your strike plus your premium. Okay? Now your profits are anything above your break even. But this is your loss at break even, profit breakdown at expiration date. So this strategy is going to be good for directional plays. So if you have a very strong opinion about it being directionally bullish, this might be a good strategy for you. Now, when you go to look at selling a call, it's going to be a credit of a cash flow, right? So credit, so money's coming in. Now the other thing to consider though is there will be a margin requirement here, okay? And we'll get more into that later on margin. But what you're typically looking for out of the stock is a declining stock or a sideways trading stock, okay? Those are about the two things you're looking for when you're looking to sell a call. The losses are going to be above the break even, and they are undefined. Okay, right? So if you buy a call and you profit can go above the break even, it's undefined. Well, your losses can go above break even and they'll be undefined as well. So really know what you're doing here, and we'll talk a little bit about that here in just a little bit. Okay? But your break even is again the strike plus your premium. So, but you're collecting the premium. This point, right? You got the credit in, cash coming in, premium, that's what you collected. So then your profit is break even to the sold strike. And then that is your max profit. If the stock ends below where you sold your strike, that is just max profit for you in this scenario. Anything in between the break even and the sold strike, it's just an incremental profit. It's not a max profit. And this is good for generating income. So if you like cash flow, generating income strategies, this is going to be really good for you. Buying puts. Okay, so buying puts. So you got a debit out, right? You're buying something, so it's cash going out. And then what you're looking for with puts is a down stock. You're looking for the underlying security to go down in value. Okay, so purchased strike to break even will be your loss. And then your break even for puts is going to be your strike minus the premium. Okay, strike minus the premium. So profits when you buy puts, they actually do have a defined amount that they can get, okay? Because the stock can only go to zero. Like there's no infinity. Like it can go down to zero and that's it. But that's not a realistic scenario for most cases of buying puts or using puts, right? We're not expecting most stocks to go to zero. So don't have those expectations. But anything below the break even is going to be profit. This is going to be good for directional plays. Yeah, if you're expecting a sell off or downtrending stock or something like that, yep, this is going to be good for a directional play on bearishness. So when you sell a put, you're going to take the credit in, just like when you sell a call. So you're going to receive cash, but there's a margin implication here. And what you're looking for is the stock going up or sideways. Losses, well, anything below the break even is going to be a loss, right? Because below break even when you buy a put is profitable. So it means if you're selling it, anything below break even is going to be a loss. Okay? Your break even when you sell put is strike minus your premium. And then profits is your break even to the sold strike. Okay, there's a strike you sold. Just incremental profit between your break even to your sold strike. Anything above the sold strike is just your max profit. And this is going to be really good for income strategy. So I'm going to give you some quick thoughts on what I think about these strategies. Okay, so the single order it's a simple order to understand. Like it's not hard. It's just one contract position. You know, you're not messing with complicated strategies and combinations and stuff like that. But it is actually more of an advanced strategy than what you think. If you are a new trader, do not use these strategies that often until you kind of get an understanding of really what you're trying to do. You really need to have a purpose and plan for what you are trying to do with the single order, okay? The biggest issue is when you're buying calls or puts, just outright, there is a theta issue. You have to be right on the stock faster than theta is going to kick your butt. And theta will kick your butt a lot. I've learned that lesson so many times. But if you're selling calls and puts, theta can really help you. So be real, but another thing is be realistic with the probability of a stock movement, okay? When you buy a call, you know, your reward is unlimited. It's undefined. I like to say undefined. You'll see other people talk about unlimited. It is technically, I mean, it's both, right? It's unlimited, undefined, but you know, that is not likely. It is not likely. So you need to really understand what you are trying to get out of a stock movement, okay? And we'll look more into that as this series goes on and how to better our reward to risk in scenarios. Never ever sell naked options, and most likely your broker won't let you do this unless you have huge amounts of capital at hand. But definitely never sell naked call options, because literally the bullet point above that says the reward is undefined, right? So you don't want to ever sell calls naked. And naked just means, you know, there's no other protection. There's no other position to offset the risk. Like you don't have a stock position. You don't have another combo position. Something like that. So we'll look into more of how to do combo positions in the future and how we can better utilize certain things. But when you sell calls, while owning long-term positions, this is great for cash flow. This is great for cash flow. This is going to be called the covered call type strategy. It's very popular. If you own stock, You can sell calls above where the stock price is, and you can kind of collect some cash flow. This is great for that. Selling puts with cash as collateral. This is another one that's really good for cash flow. This is actually called the cash secured put. Okay. Another thing to kind of know about option strategies is there's option strategies and how you enter the order, and then there's option plans and strategies that are evolving. They kind of work over time. So you're constantly putting on positions, putting off positions, but they're meant to work over time as part of a plan. Okay. A great combination strategy between selling calls while owning long-term positions and selling puts as cash collateral is called the wheel. And I will go into an in-depth breakdown on that video. So let me switch over to the broker, and I'll be back in 1 second. Okay, so here we are in the broker, and we're just looking real quick here at the SPY, just here in my demo account. And what we are going to do is we are going to very quickly look at some risk profiles of each one of those 4 positions and just kind of get a visual understanding of how we can expect these strategies to kind of look at expiration, okay? And even before expiration. So what I'm going to do here is we're going to start with the basic buying a call, right? So I'm just going to click on one of these and open up an order sheet. Now there's a couple ways, if you're using Thinkorswim, there's a couple different ways you can do this. If you come over here to the hamburger menu on the right side, you can click that. You can right click right here, just anywhere on this order line, and just go down to Analyze Trade, and it'll pop this up. So this is your basic risk profile, okay? And what we are looking at is on the left side over here, you see the dates, okay? You see the dates. Now we picked the December 23rd strike call. I don't even know which call we picked, the 468 call, and it's currently trading around 252. Okay, so the graph might move around a little bit. The market is open, so things might move around a little bit. It's not a big deal, but as you can see right here, this pivot that is the 468 strike. So whenever you see a pivot, and this teal line, don't worry about the purple line for right now. This teal line is your risk profile at expiration. Okay, so I'm gonna see if I can blow this up a little bit better. So it looks something like that. Okay, so 468, boom, at expiration is what you can expect. Above that is where your option starts to have value. And then remember, the break even is you add 468, your strike, plus your premium. That would be 470.52, which is right there. 470.52. If you can see that value down here, just below the cursor, 470.52, right? And this thicker line is 0. So that is where you are breaking even, and that's where they intersect. Okay? So where they intersect, that is your break even. Below that, right, we have losses. Below the 0, that's our losses. Okay? And it's flattened out, right? So that is your max loss. Anything below the strike that you bought, that is your max loss area. Anything above your break even, that is when you start to have profitability. Anything between the break even and the strike, that is a fractional loss, not a whole loss, you know. So that's just kind of it is what it is. It wasn't right, wasn't wrong. I mean, you were wrong. If you lose money, you're wrong. so it is what it's okay. But you just have an incremental loss. It's not a full loss. So obviously, this is what you're really looking for, right? When you're using this strategy, you're looking for a thrust higher to get higher price levels so that you can profit, get into higher profit areas. Okay, so let's look at this. So this purple line, Okay, what this purple line represents is roughly that value of the option today. Okay, so if I was to buy that option now, this is my break even. My break even right now is at like 460, 450. Okay, and then down over here, you can actually advance it a day or two. So as you advance it a couple days, you can see where your break even would be in a few days. Right? So that was going forward 3 days. Now you can see where your expected break even would be. It'd be about 466.44. Okay? So you can really see how far you need this option to go by what time period. So this is a really good tool to kind of come in here and see what your expected value would be by a certain date. So feel free to definitely utilize a tool like this because like if you want to buy an option about 6 months out, but you want to see what the value of it would be in 3 months, if you use some analysis, if you want to see what it might be in 3 months, you can do some analysis like that. So this is really good for helping to understand what the value change will be over a given time period, right? Because you don't have to hold whatever position you get into. You don't have to hold it to expiration. You don't have to hold, because that's what the teal line represents, right? Expiration. The value of the option at expiration. The purple line represents the value of the option on whatever day it is, right? Or whatever day this is down here. Down on the bottom right? So you can go forward in time, or the day here. You can see the day here. So you can go forward in time and just kind of get an understanding of what the value would be on a future date, right? So I can go forward on a few days, and my break even is going up to 465.57, right? If I go back to today when I entered it, it was 464.47 or so. So you can really see how time will impact time and price will impact your option value here. Okay. So what about if we didn't buy an option? What if we sold this call, right? Well, it just flipped it, right? You just flip it on the zero axis here, right? Just flip it. You have limited gains to the downside. You have incremental gains. You have incremental gains to break even, right? Between the strike that you sold, if you sold the 468 strike to break even, and then anything above, if anything the stock does above that, that's a loss, right? And the losses get larger the farther the stock goes. So obviously you're looking to do this on strategies that don't really have an accelerated upside chance, right? You're definitely not looking to do this like on Tesla in 2021 or 2020, stuff like that. You don't want to do this kind of strategy on, unless you're doing like a combination of like owning the stock or something like that. But doing this kind of, you can bring in some good cash flow, right? Bring in some good cash flow. So that's how selling a call will look. Let's look at put. So I'm going to change this down here. I'm just going to change this over to put. And then I'm going to go a little bit lower. Go to 460. So this is a risk profile for buying a put, right? So 460 put option. December 23rd, we're buying one for, let's say, 286, right? So we're buying it for 286. And so let's go find where our pivots are. So our pivot's going to be right here, 460, right? Anything above that, the definition says that is going to be our max loss. Anything above 460 will be our max loss. Anything between 460 and break even on the teal line, that will be our incremental loss. It's not a full loss, right? And then anything below break even, our put makes money. Our put option will make money. Now that's at expiration, right? And in the purple line, you can see where the value would be given if the, where are we on the SPY? So we're looking at the SPY here, right? So that's like where our break even is. That's like kind of like where the current market is, right? That's where we currently got in. If the SPY were to drop to maybe like let's say 459.50. So if it dropped to like 459.50, the value would roughly, of this option, would roughly be around $210. 207-ish. So about $207. That's about how roughly the value of this put option would be if the market were to drop to 459.50. Okay? Now, the difference between these two lines, okay, that is value that will be sucked out by expiration. Now, what if we sell a put option? So when we sell a put option, we're just going to flip this risk profile, right on the 0 axis, and your break-even point, right? If we did 460, if we did the 460 strike, but then we got a minus this premium we did, so 460 strike, so it should be 457.14, and that is pretty much right where the break-even mark is, right? 457.14 is the break-even. So anything above the 460 strike is going to be your max profit for selling this put. Okay? And then anything between that 460 strike to break even, that's going to be an incremental profit. And then anything where the stock is below that break even, that is going to be a loss. Okay? So that could be not necessarily a bad thing on a loss. Like if you're looking to buy the stock, like, hey, I'm going to sell this 460 option, just looking to collect some cash flow until it breaks down below 460, you collect cash flow, and then when it gets down below there, you might take a loss. It might get down to 455 or something like that. You might take a loss on that contract, but if you've been doing it over a period of time, you've been generating some cash flow. Okay, so this is just to help you understand and how to look at the value of your option at a given point in time, right? With the purple line is anytime between now and your expiration date, and then the teal line is going to be your expiration date. Now, I think Thinkorswim sometimes just randomly colors these lines, so they might not be teal or purple if you use Thinkorswim all the time, but regardless, you can kind of tell. Usually the expiration line, if you do look at this and you got different colors, or you're looking at a different program or something like that, typically the expiration line is the line that is most like straight edges. Like there's no curvature to it. Like obviously you can see this purple line has curvature to it. Usually the expiration lines have no curvature. They're straight in, they're straight on a value perspective, or just straight like in a diagonal perspective. So, but that is how you use like risk profiles to better understand what your option is expected to do at a given point in time, or the value of your option at a particular strike, right, or a particular price level, right? Because if your option here like went down to 451, well, you'd be losing $737, okay, roughly $767 is what that said, right? Yeah, roughly 770 or something like that. So understanding your risk profiles just really will help. Now, this is very basic, so when we get into covering more advanced strategies, and we'll look at some other strategies, and we'll look at this risk profile in those strategies, it will really help understand, where your reward, where your risk is, and that kind of stuff. Okay? If you like this kind of breakdown stuff for risk profiles, give us a like, comment on what maybe I left out. If you want me to clarify something, yeah, definitely feel free. Let me know. Definitely can clear up anything you want. If you need a better understanding of calls and puts, just click the video on the top left. Alrighty, take care, Alpha Hunters.